Hey everyone, it's Dr. DeCubellis here from Main Street Chiropractic. Today I'm joined with Scott Rausch.
How you doing? Scott Rausch, Caliber Home Loans, NMLS number 187488.
And the reason I wanted to have him in is because in the last year, we've noticed a lot of changes with the housing markets, and he's a mortgage expert. So I wanted to ask him some specific questions that I've been dying to ask someone. I think people will kind of get interested. So thanks for coming out.
You're welcome. Thanks for having me. It's an honor.
So first, let's start kind of telling us a little bit about yourself, how you got involved in the mortgage industry.
All right. So I had the pleasure of graduating from college in the middle of a recession, and I couldn't really get a job. And then I had a couple of friends that were in the mortgage industry said I should do it. And one of the friends' dad was a boss, so they hired me as a mortgage guy. So it was purely by accident, although I was looking in the financial services arena because I always wanted to help people. So I thought I wanted to be in financial services, and 30 years later, here I am.
So, that sounds good. So with you being involved with the mortgage industry for so long, obviously you've seen different trends and things, but last year we had a totally new trend come up with everything. So first question is, what was the first thing you noticed when things started to first hit, like around March, or did it take a little bit longer for anything to change?
It took a little bit longer for things to change. The first thing that happened was the government came out with their policy on forbearances and freezes on foreclosures and stuff like that. So as a result of that, they also tightened up some of the guidelines. They called them COVID temporary rules and stuff like that, which since they've relaxed them considerably. But the main thing was we had to be more cautious about verifying people's employment and that they were still gainfully employed. That way they're, on paper they still qualify for the house. That was the main thing, is that, you used to be able to verify 10 days prior to closing they were gainfully employed. Now you had to do it no more than 3 days before, but you had to get somebody in HR to respond, and sometimes that's a little bit of a challenge.
That makes sense. And then when would you say that you started to notice just like the volume of purchases and refis and things starting to like really uptick?
Well, so it was busy before COVID came into play, and so we've really been on like an 18-month, sprint. It's been tremendously busy for about the last 18 months. Rates had came down before COVID really hit, and that just kind of put the icing on the cake and lowered it further. So we were busy all along with purchases, and then you got to throw refis into the mix. So we have people routinely working. My operations staff have just done a phenomenal job. You have people working 15, 18-hour days for several months in a row. So there's a bit of a burnout, type thing. But all in all, we weathered through it. As I tell people, name another industry that could be 300 times over capacity and still function.
Yeah, definitely very interesting. Now, would you say in the last year you've processed more like new home mortgages or refinances?
It's been pretty balanced. Traditionally, I'm a purchase oriented, and my office we've built a purchase oriented branch, and the company is a purchase oriented. So we had a little bit of a blip where I'll say probably in April of last year, we probably had the most amount of refis happening. But traditionally speaking, we run right around 80% purchase, 20% refis. Last year was a little bit different. We were probably 70% purchase, 30% refi. It was a tremendous year on all fronts. So we've never turned our back on the purchase business, but certainly I can speak for myself. My refis were not, I wasn't buying leads. I wasn't, calling, dialing for dollars type thing. Strictly previous customers and referrals from previous customers for me. I don't really focus on the refinance aspect. I do it for my friends and family, but I don't go out searching for it.
That makes sense. Now, when it comes to those new purchases, did you notice anything, especially let's say initially when COVID hit and all restrictions started coming out, did you notice anything in like a delay with processing because it was harder to get people either into a home, or those bidding wars we hear about were going on?
So the bidding wars were happening. We had tons and tons of people, and I had several customers that basically they got outbid on 10 or 11 different houses, and the challenge is to not let them get frustrated. There was a little bit of a lack of inventory, and the lack of inventory though is something that we've been dealing with in the Chicago area for 5 or 6 years. So it's nothing new. There's just, people aren't selling, they aren't moving up. There's a lack of new construction and stuff like that. So we did have the shortages and a little bit of a burnout rate with consumers, but those, I always remind people, I use an analogy of going to the dog pound, right? You don't pick the dog, or the dog picks you. Not that house is the dog, but when the right house comes along, it's going to come along. It's going to fall into their lap. Many times it's a better house than they originally were bidding on, sometimes less money, better neighborhood, something worked, everything lined up perfectly.
Right, yeah, that makes sense. Now with that too, with the prices going high, how has it worked when people trying to get a mortgage, they finally get, they get chosen to purchase this house, but maybe it's not where the appraisal comes in? How does that process work?
Well, so in terms of houses coming in under appraisal, so I've been blessed. In the last year, I've only had 2 houses where it came under, one of them right now. And I always go to my partners, my realtor partners, and say, hey, what do you, where did you comp this out at? And a lot of times they'll be like, yeah, the appraiser's on the money. So they'll go back to the seller and say, here's the appraisal, and we kind of agree with it. So we're asking you to lower the price. Now, sometimes they will, like the one I have right now, they were getting a closing cost credit. They're not gonna get as large of a closing cost credit, but they're gonna lower the sales price to match the appraisal. So it worked out fine. The other one was they were just off the reservation. I mean, it was $50,000 over the listing price. The house appraised for $15,000 more than the listing price, but the seller wouldn't budge. So then they got to make a decision. Either they're going to put the money out of their pocket. I always tell people, so the answer is if it under appraises, you always have the right to appeal the appraisal, but you have to find comparables that are recent, within a mile, within 20% of the gross living area, similar houses. You're not going to compare a house that's 50% bigger in a gated community versus a house that's not in a gated community. You're comparing mangoes and grapes. You have to have like houses. So you always have the right to do that. We've had a couple that did come in low. We were able to appeal it, and the appraiser reconsidered it and said, you know what, yes, you're right, I'll raise the value based on the comps that you have. And I always tell people too, appraisals are a snapshot in time. Tomorrow, the value could be totally different. If something was pending and now closed, that becomes the value now in the neighborhood, or it impacts it either positively or negatively. So, I wouldn't get worked up too much about the valuation, especially if you're doing a refi, because again, it changes every single day basically. So that's the point, is it's a snapshot in time.
Now, a follow-up question on that. So if we talk about appraisals like that way, but then if we look at how you were saying earlier, how there's just such lower inventory than normal, do you think at some point in the future, maybe a year or 2 down the line, when people are trying to purchase a house at that time, there are no comps? Like, what happens then?
Well, that could happen, and sometimes, I'm blessed. I have a lot of friends that are appraisers, and they're like, hey, I think the house might be worth it, but I've got nothing to justify it. I have nothing to support it. That happens, sometimes that happens every year in the early part of the spring, because remember, in the winter it's been dead, and that's when people tend to get the best deals, because there's less people shopping, more motivated sellers, because there's not a lot of people coming through, and sometimes that happens, and unfortunately it is what it is. Fortunately, over the years, we've had a pretty stable market. The appraisers can use a little bit older comps that help bridge the gap, if you will. They can also do time adjustments. If we're in an increasing market, the appraiser has a comp that closed 6 months ago, they can apply a multiplier. They have to support it, obviously, but they can apply a multiplier and increase, say basically that house is worth more if it were to sell today than it did 6 months ago. So they do have tools at their disposal to kind of equal it out.
Okay, that makes a lot of sense. Now, when we talk about mortgage and mortgage rates, obviously mortgage rates, they never stay the same. They can go up, they can go down. Is there anything that with mortgage rates, just so people know, is there any correlation between mortgage rates and availability of houses, or are they completely different?
So mortgage rates, the easiest way to explain it is basically you want to watch the 10-year bond yield. So a mortgage is essentially a bond, right?
Mm-hmm.
It's a promise to pay back a certain amount of money every month and stuff like that. So if you watch the 10-year bonds, if the bond yields go up, interest rates most of the time will go up. Likewise, when yields go down, they'll also go down. Now there becomes a point where the secondary market says, we don't care what the bonds, we're not going to go any lower, because remember, it's an investment, right? Somebody's buying that mortgage-backed security, whether it be a pension fund or a school board. Somebody's buying into the mortgage and owns your mortgage. So as a result of that, it follows economic stuff. So I tell people, generally speaking, bad economic news is good for interest rates. Good economic news is bad for interest rates. And supply and demand do come into play. You typically see a run-up of interest rates in the spring. You can almost set your watch by when the weather's changing, by the way. I find every year, as soon as rates jump, I go, oh, I guess spring is here. Likewise, in the winter, rates tend to be a little bit lower because there's less people out buying houses. So it does have a supply and demand component to it, but it's more about the overall economics. That has a bigger effect on interest rates than really the spring season or lack of inventory and stuff like that.
Okay. Now let me ask you this: when it comes to refinancing, is there any kind of general rule of thumb to figure out, okay, is it worth it? Like, is there a point percent that needs to be there, or does it change if values go up, or is there any kind of rule of thumb?
So if you also have to ask the motivating question is why are you refinancing? Are you refinancing because you're hearing all your friends go, oh, you should refi? Or are you refinancing for a specific reason, like to drop mortgage insurance? Or are you taking cash out to invest into your business or do an addition? We saw a lot of that last year. If it's to save money, sometimes I did a lot of what I did for a lot of my customers was, rather than going back to a 30-year mortgage, I put a lot of them into 20-year mortgages, because there was enough of a drop in rates that their payment was almost the same, but they were cutting 10 years off the back end of the loan. So if you're going to be there long term, that makes a lot of sense. I always say, in terms of closing costs, you want to get your money back within 2 years. If you can't get it back within 2 years, then you may not want to consider doing it. But if you're doing it to cut money off the back end of the loan, then it becomes less of an issue. Like, for example, if you're going from a 30 to a 15, your payment's absolutely going to go up. So in that scenario, it's a big picture thing is, I'm going to be here long term, but I want my house paid off in 15 years. As a result of that, though, I'll probably save $100,000 or more on the back end of the loan by paying it off early. Does that make sense?
Yeah, definitely. And now, is there, because you've got 15, 20, and 30, are those the two?
Well, the main securities, so when you look at the market, the mortgage-backed securities, there's two main coupons.
Okay.
There's a 30-year and a 15. Now, we as a servicer, we offer a 10, a 15, a 20, a 25, and the 30. So but the 20, 25, and 30 are based on the 30-year coupon, the 15 and the 10 are based on the 15-year coupon. So,
okay.
But you can customize, look, you can customize your mortgage however you want to pay it back. I tell, typically I like to see people do a 30-year, and I always say you can always pay a 30-year off early, but you can never pay a 15 off late. So what happens if you, God forbid, you get furloughed because of COVID or some company downturn or something like that? If you take a 30-year mortgage, that has the highest interest rate, but it also has the cheapest payment. But you can always pay it off early and pay extra. But if something happens, you can just jump back to the normal 30-year payment, no foul. And all that extra money went towards your principal, reducing your principal anyway.
That makes a lot of sense. Now let me ask you this, looking at kind of a global thing, what's the biggest change in interest rates you've noticed over like a 6-month period in your career? Was there ever been anything that's been like, wow, that was crazy?
So and by the way, the Federal Reserve, I know on the media, they always go, the Federal Reserve today raised mortgage rates or they lowered mortgage rates. That's a half-truth statement. So the Federal Reserve affects short-term interest rates. That would be equity lines, so that's where the media gets the free pass, because it's an equity line. But when you're talking about first mortgages, they follow the bonds and the mortgage-backed securities. So I've actually, in my career, seen several refinance booms end with a Federal Reserve cut. Why? The bond market didn't like it. If the bond market doesn't like it, that's going to cause a big jump. So I've seen rates over a couple week period of time go from like 8% to 10.5%. Like in 1995, it was almost overnight. It was like within a couple days, rates went from like literally 8% to like 9.5%, 10%. They settled back down, but they still had that big jump. So that's what I learned. It was my first stint as a manager, and I had several loan officers that promised rates that they didn't lock because they were greedy and playing the market, and I made them honor it. So I had loan officers actually have to write checks to close loans, because if you tell a customer you're locked, by law they're locked.
Right.
That was on the loan officer.
That's crazy.
Yep.
Well, a lot of good information. Is there anything we didn't talk about that you wanted to mention?
Well, in terms of the inventory, so a couple things that I hear this all the time. So an interesting study I just heard was that we have basically 1 million fewer houses for sale right now than we did this time last year, which is interesting because if you think about it, this is in the middle of the pandemic, so people were out shopping when they weren't working, they were out shopping for houses, right? Or they had flexible schedules, we'll say. So the big driver right now in the lack of inventory is 3 generations are in the housing market actively. You have the baby boomers, you have the Generation X, and you have the millennials. So you have 3 generations. This is the first time in my career we've had 3 generations fighting over the same houses. So, we haven't been building houses at the pace we've needed to as a country. Our population size has grown between immigration, birth rates, and stuff like that. Our population is growing. We don't have enough housing in America. And of course, with material costs being high, that's not helping the situation. But it'll work itself out, but it's probably gonna take a while. In my opinion, the housing market's gonna remain strong for several years. So I don't see anything that's gonna change that, for reasons I said. You're still gonna have inventory issues going forward.
Makes sense. So don't wait. If you find what you want, just get it.
Yep.
Sounds good. Well, Scott, thank you for coming out. Hope you guys enjoyed this. If you have any questions, you can get in contact with him. Information's down at the bottom. So definitely reach out. As you can see, he's very knowledgeable about this. And yeah, thanks for coming out.
Thanks for having me. It was a pleasure.
Yeah, no problem.